Hi, this is JR with Adaptive Budget Consulting. This is benefit from change. Benefiting from change is as easy as A, B, C. We could list a few different things as the A, the B, and the C, but I'll start with this. A, study change. B, notice and adapt to change. I could have made that B and C right there. And then C, or finally, benefit from change. So study change, notice and correctly understand, correctly interpret change, or at least see how a few different interpretations vary in their relevance. And then adapt to change based on what's relevant for a particular case. And then benefit from change. So things change. Your budget, for instance, can change. It may have already changed greatly within the last few years. The budgets of many people and many organizations have changed significantly in the last few years. And you may have noticed that. And in fact, a lot of budgets have changed in similar ways in the last few years. So you may have been surprised by this pattern of changing budgets and the related changes in economic behaviors, which are consequent to those budget changes. I'll say more about that later. So as things change, different people may notice a particular change at different times, right? A few notice first, some notice second, many notice much later. As different people notice a particular change at different times, they begin to adapt to that change, or they may begin to adapt to that change. A few adapt first, some adapt second, many adapt much later. Also, when someone understands a change that is emerging, they may also have additional time to understand the change in relation to other changes, right? In relation to various alternatives, and they may know how to adapt to it well. They may know what is relevant in their particular case, in their own case, in my own case, or in your own case. So people who notice the change first not only can adapt first, but may also adapt with more clarity, more relevance in terms of their own situation, their own circumstances. So people who only notice a change much later may be so surprised that they react to the change suddenly without actually being clear about exactly what is changing. They just notice a particular symptom or a few particular symptoms. They don't necessarily notice what's happening in the long term. They just notice some short-term symptoms. So budgets are what is changing. In fact, budgets are always changing, but sometimes there's a change in the pattern of how budgets change in a bunch of different budgets of a bunch of different people and a bunch of different organizations, even a bunch of different governments, all change in similar ways at a certain time, in a certain period of time. A big pattern of change in budgets in this case. So in 2002, I noticed certain changes emerging, particularly in the behaviors of lending and borrowing, but also of buying and selling. In early 2003, I published Why Are Investments Diving, and What Can I Do About It? And what I meant in particular was stock market prices in the U.S., which had gone down over 40% in the broad U.S. market and over 70% in the case of the NASDAQ stock exchange, which is a lot of technology, high technology companies and internet companies that had just had a big rise in prominence in the late 90s, but then suddenly declined very far. 70%, more than 70% declined in a few years. So that was early 2003, March 3rd, 2003. Here's a key concept of that piece. Price changes are based on willingness and ability to buy and sell. Willingness to buy and sell and ability to buy and sell. And of the two, actually, ability to buy and sell is the most conclusive. By ability to buy and sell, I meant the budgets or cash available of people and organizations. So when budgets change, then perceptions and psychology change, or willingness, further resulting in behavior changes of buying, selling, borrowing, and lending. Changes in those behaviors, in patterns of those behaviors. So when the behavior finally changes, the prices reflect that change. Various prices. Prices of real estate, prices of different stocks, prices or purchasing power of currencies and exchange rates of currencies. All the prices are kind of the last thing to change. Prices are, in terms of market prices, are a reflection or an indication of what just changed already in the buying and selling behaviors. So when the behavior finally changes, the prices reflect that change. So when budgets change first, that increases or decreases the ability to take various actions by various people and organizations and so on, decision makers for those organizations. And as the ability to take various actions change, that changes the willingness to take those various actions, because if they're less able to, then they're naturally going to be more conservative. If they're more able to take a certain action, then they're perhaps more likely to explore that alternative because of their increased ability. So budgets change first, then the ability to take various actions, then the willingness to take those actions, and then the actual actions change, the behaviors change, the activity changes. And then the new market prices eventually measure the prior changes in behaviors, perceptions, and budgets, in behavior and willingness and ability. So below are a few more brief highlights of that March 2003 article, applying the above concept of ability to buy and sell and willingness to buy and sell resulting in price changes. Here are a few highlights from that 2003 article applying that concept to prices of U.S. real estate, gold, and oil, as well as the foreign exchange rate or currency exchange rate of the U.S. dollar. So here's what I wrote in 2003. I'm going to actually read it basically exactly as it was written. I'll just leave out a couple of lines, but everything I'm about to say is what I actually wrote, and you can check the article as you see fit. We can profit from the collapse of the credit bubble and the subsequent stock market divestment. However, real estate has not yet joined in a decline of prices fed by selling and foreclosing. You may deem this prime time to liquidate investment property for use in more lucrative markets. So I wrote that in March 3rd, published that March 3rd of 2003. So some of those terms may be unfamiliar. Divestment, for instance. We can profit from the collapse of the credit bubble and the subsequent stock market divestment, also known as more selling than buying. That's divestment. It means more selling than buying, which results in declining prices. However, real estate had not yet, as of March 2003, joined with stocks, in particular technology stocks, in a decline of prices fed by selling and foreclosing. So I emphasize yet. I'll come back to that. Real estate prices as of March 3rd, 2003 had not joined yet in a decline of prices fed by selling and foreclosing due to the collapsing of the credit bubble. And by real estate there, I did mean U.S. real estate, but it's also true in various parts of Europe and elsewhere. So what I wrote at the end there was, you may deem this prime time or perfect timing to liquidate or sell investment property, real estate, for use in more lucrative markets. And I mentioned some of those more lucrative markets in a moment. Already as of 1999, U.S. bond market was rallying. Oil prices had risen over 200% just from 1999 to 2000 and continued to press on higher, though they had dipped somewhat as well in 2001 and 2002. But gold also was rallying as of March 2003. Many markets were rising newly just in the last few years, had reversed and started to rise, in contrast to real estate, which had been gaining for quite a long time. Real estate overall had done pretty well in the U.S. and other places. So, another excerpt from that March 2003 article. As with liquidating real estate investments, you may deem this prime time to join in the ranks of those who've been reallocating their assets from dollars to something more stable. I meant U.S. dollars. And in 2001, that was the point of reversal in the U.S. dollar index, a index of foreign exchange rates relative to other major currencies worldwide. So already, by March 2003, I was saying to join the ranks of those who have been already reallocating their assets from dollars to something else, other currencies. Euro, yen, many others, Swiss franc, etc. So, a next and final excerpt from that March 2003 article. More and more investors will reallocate to more stable investments like bonds or more lucrative investments that are rising dramatically, like commodities, especially gold and oil. Again, as of that time, oil had already risen hundreds of %. Gold had already made significant gains as of March 2003. The U.S. bond market had made significant gains, at least significant relative to historically what had been going on with bond markets, and also bonds were doing much better in the prior few years than U.S. stocks, which had dropped more than 40% since 2000. So that gives you a sense. I talked about the future, what will happen, what hasn't yet happened, a sequence of events, right? What's a good time to sell now, right? So what has happened since that March 2003 publication? Was there a wave of real estate selling, foreclosures, and falling prices? Yes, and it started to show up in the U.S. by mid-2005 in places that previously had been leaders in the real estate boom, like Phoenix, Arizona, and Las Vegas, Nevada, where prices fell by over 50% so far. So those places began to have declines in their real estate markets prior to the rest of the U.S., and the declines have been much larger so far than the declines so far in the rest of the U.S. Again, in parts of Europe, different parts have had bigger declines in real estate values. In Japan, different parts have had different declines, and the timing for Japan is significantly different, starting more than a decade before the declines in the U.S. and Europe. But let's move on. I had mentioned real estate would decline. It has, obviously, dramatic, historic declines, just like I was making reference to in 2003 and 4 and so on. Did the rise in bonds, gold, and oil continue? Did they continue? Again, the oil prices tripled from 1999 to 2000. Gold and bonds had also reversed years prior to that March 2003 publication. There's already years of a long-term reversal, because when I say long-term reversal, note that oil prices had come down. Let's even put it in terms of gasoline. Gasoline prices had come down about 50% from 1919 to 1999. In inflation-adjusted terms, gasoline prices in the U.S. had come down about 50%. With technological advancements, computers being, the whole industry of computers was developed, and it was much more cheap to find and extract and refine oil than it had been, in so much time. And of course, in the 70s in the U.S., there was a temporary increase in gasoline prices and oil prices. But overall, the trend from 1919 to 1999 was clearly a decline in prices of gasoline in particular, and that reversed in 1999. An inflation-adjusted cost per gallon of gasoline in the U.S., that trend reversed in 1999. I didn't make any reference in the March 2003 article to gasoline in particular that I can recall, but I did make reference to oil and other commodities. So did the rise in bonds, gold, and oil continue after 2003, the rising that had begun years prior to that? Yes. In the case of gold, oil, and bonds, those rises continued. Now, while the rise in, and there's a chart of the relative gains there in those three markets, while the rise in bond prices may look tiny compared to oil's 4-digit gains or even gold's 3-digit gains, let's compare it to the broad U.S. stock market, the S&P 500, and the technology-heavy NASDAQ 100. There's a chart showing how much more stable bond markets had been. And yes, bond markets had periods of decline, but overall they gained, on the whole, significantly relative to stocks, especially tech stocks, which fell, as I said, over 70% from 2000 to 2002. So finally, let's look at the U.S. dollar index of foreign exchange rates against other major currencies. Declining from its high in 2001, it fell over 40% by 2008. So it also continued the prior trend that had began in 2001. It continued beyond my March 2003 publication in which I suggested it would continue. It continued all the way until 2008. It may continue further, but there has been a reversal of the decline in 2008, a significant interruption. It's been a couple years since it's even come especially close to its 2008 low. You can see the chart and see, exactly what the U.S. dollar index has done from 2001 to 2008, and even till now. Today is actually the 13th of March, 2011. So I want to emphasize again the word yet. I had mentioned that in regard to real estate. Various changes were obvious by early 2003. They'd already started, given that many of them started in 1999. But real estate, I said, has not yet, as of March 3rd, 2003, joined with stocks in a decline of prices fed by selling and foreclosing. I understood that it was prime time to start to look to exit real estate because of what was coming in budgets and what would be coming in spending and borrowing and so forth, and selling and lending behaviors, and then what would come in real estate prices and the effects that would have on industries within the U.S. and bankruptcy rates and foreclosure rates and the U.S. economy as a whole. And not just the U.S., it's much bigger than that. It's in Europe, it's in other places, it's been in Japan for a long time. So, by noticing changes early, but then also understanding them in reference to prior historical sequences, and just in general, not just like the whole Japanese situation in the 90s, but even just what had happened in 1999 and 2001 and 2000 and so on. Just understanding the sequence of events. By noticing the changes early, understanding the sequence, and that ABC thing, again, of, well, budgets change, then perceptions and willingness and ability change, behaviors change, then prices change. Well, it wasn't a big surprise that fuel prices were going to continue to rise. They'd started rising in 1999. They would continue rising. There would be implications and consequences for budgets. And then it was easy to notice what would happen after those budgets of people and households and governments and organizations were changing based on rising fuel prices. It was easy to anticipate how that would also affect their other behaviors of buying and selling and so on. So by noticing certain changes early, then also understanding them in relation to each other and previous historic sequences, I was able to expect, by early 2003, a future surge of foreclosures in real estate markets, and of course also tremendous declines in prices. But that had not started as of 2003, not yet. In 2004, I published The Real U.S. Deficit Oil, in which I introduced the term the domino effect. The domino effect. Like domino effect, but with oil. I detailed the predictable future of rising fuel prices. Again, they already had been since 1999. Oil had risen hundreds of percent just from 1999 to 2000 in those 2 years. So I detailed the predictable future of rising fuel prices and the chain reaction, like a domino effect, that would destabilize real estate markets, which started in the U.S. in 2005, as well as destabilize stock markets, which started in the U.S. in 2007. Note that I repeatedly say in the U.S., because similar changes showed up in the former USSR, in Japan, And in the EU, just prior to, or just along with the changes in the U.S., but the ones in USSR and Japan were over a decade prior, as far as those sequences beginning. The domino effect, or the domino oil effect, like a domino effect. So we'd seen prior sequences. When I say we'd seen them, we could see them. You can look now. You could have looked years ago. We can see these sequences. We can anticipate what's naturally going to result from fuel prices increasing. And why would we know that fuel prices would increase? There's another point of reference there, another point to make there. It was not hard to notice that fuel prices were likely to increase because production of oil as well as gasoline was anticipated to peak in 2006, by 2006. Geologists, going back to the 50s, if not earlier than that, the 1950s, if not earlier, Hubbard from the United States Geological Survey, or USGS, he anticipated the peaking of oil production in the U.S. and the consequences, and he made those predictions based on the peaking of oil discovery decades prior, and the forecasts of how quickly those oil deposits were being extracted, when the production peak would be in the U.S., and what would be the consequences to the U.S. economy. So when production in the U.S. peaked in 1970, and then the U.S. increasingly had to depend on Middle Eastern and other oil imports, it affected the U.S. dramatically. It didn't affect the whole world dramatically, but it did affect the whole world some when the U.S. peaked in its oil production, given that the U.S. had been the #1 producer of oil worldwide. When the oil production of the U.S. began to decline year after year, starting around 1970, that affected oil markets worldwide, but not nearly so much as when the entire global production of oil peaked in 2006. And in 2004 and 2005, and even decades before, geologists and myself, in 2004 and 2005, we anticipated the peaking of oil production worldwide and the natural consequences on budgets of people, organizations, and the decision makers within those organizations, and what would happen as a consequence of fuel prices rising dramatically, hundreds of percent, even 1,000% in as little as a decade, from $11 a barrel for oil in 1999 to $147 or $148 a barrel in 2008. So in 2005, I published Worth Its Weight in Oil, contrasting oil with gold. His traditional statement is worth its weight in gold. I was saying that's not important. Worth its weight in oil is the saying to be more attentive to. In 2005, I published that, contrasting the practical economic importance of fuel with the relative triviality of something without widespread practical value like gold. Gasoline is inherently valuable to a lot of people. Gold, that's just something people use so they can buy gasoline. Gold has very little inherent functional value to the vast majority of people, and it's mostly valued because gold can be exchanged to eventually get things of immediate practical value like gasoline and other raw resources that are industrial resources or household resources. But people don't normally use gold, in an industrial capacity. That is used in some computers and in certain applications. Of course, gold is used in an industrial setting, but gasoline has widespread use, and gold does not. Oil does. Natural gas does. Even firewood does. Gold does not. So, Worth Its Weight in Oil, I published in 2005. So budgets are the core issue, particularly the effects on budgets of the cost of fuel. The rising cost of fuel is going to affect budgets. So budget's kind of the place where people notice it. yes, it's easy enough to anticipate oil production rates and price of oil, given the demand for gasoline and oil were continuing to rise dramatically, especially in Asia, while production was flattening, less and less increases year after year, and then suddenly peaked and started to decline year after year in 2006. So it was easy enough to predict those economic changes, but the budgets is where it started to affect people's everyday behaviors, because they didn't have as much money left after spending money on rising fuel prices. So when people and organizations presumptively speculate or project about their future fuel costs just from prior years or prior decades without researching the reality of global fuel markets, then their budgets can decrease suddenly and surprisingly. They may also have been surprised at the natural consequences of the wave of decreasing budgets, not just the decreasing of their own budget and budgets of many other people, including decision makers for businesses and governments. But with that wave of decreasing budgets, there's natural consequences from that. And the natural consequences include less spending on things besides fuel, and thus less lending, since there was less surplus cash available to lend after fuel expenses. Less surplus cash to invest in expanding business and hiring more employees and building more plants or manufacturing facilities. So when there's more money being spent on fuel, there's less money available for everything else. Investing in stocks, investing in real estate, lending to other people, hiring employees, buying shoes, buying computers, whatever. So, the particular markets that would be affected by selling, too, as people were buying less and then even selling more so they could afford extra cost for fuel, they were going to sell certain things potentially so that they could afford fuel, right? So what's the markets most sensitive to changes in lending and borrowing patterns? I identified it again back in early 2003, real estate. Real estate would be sold. There would be foreclosures. People would be forced to sell it. They would simply not be able to afford their mortgage payments. And again, I haven't mentioned this yet, but in this video, but in the 70s and in the 80s and for decades in the U.S., there had been a series of political interventions to encourage people to own real estate, even though those people might not be able to really afford it based on their own revenues and income. But they had FHA programs, they had HUD programs, they had VA programs, they had Fannie Mae and Freddie Mac, and all sorts of incentives, tax breaks, all sorts of things for people to buy real estate. And then in 2000, I believe it was 2002, the Federal Reserve dropped their prime rate ahead of U.S. Treasury rates, open market interest rate in the U.S. Normally, the Federal Reserve follows the borrowing patterns that produce the yields or interest rates of bonds or U.S. Treasury notes. But in an unusual event, the Federal Reserve dropped their prime rate, making it a lot easier for people and businesses to engage in financing real estate purchases. So it created this really disproportionate advantage for real estate over other markets, but it was temporary, of course. So that's part of why real estate, as of 2003, hadn't yet begun to decline, even though stocks had declined over 40% overall in the U.S. As oil and gasoline prices were beginning their rise in inflation-adjusted terms since 1999, and as bonds were gaining relative to U.S. stock market, many people were surprised. Housing prices, real estate prices, continued to rise all the way into 2005 and beyond that in most parts of the U.S., given these political interventions, decades, and then even that last ones in, well, those weren't really the last ones, but very significant ones with the dropping of the prime rate in 2002 or so. So there's natural consequences to all of these economic things as well as all of these political interventions. the most important ones are the economic ones because those predict the political adaptations. Bankruptcy laws changed. Political disruptions in parts of the world. Budgetary issues for many governments. Changes in how governments would spend money, which functions or which operations of government, which departments, which actual programs, which ones would decrease their funding significantly, which ones would increase their funding. How would tax rates change based on these budgetary issues of governments? All of that was predictable. And in fact, myself and many other people predicted them. Myself, starting in 2003, is when I published references to these things. And later publications, I was talking about some of the different variations. But the point is, not everyone was surprised at these natural sequence of events. Many people noticed these changes early, or at least a few. Many people understood the changes emerging, or accepted the assistance of someone who did understand, and then attentively or responsibly adapted to what is actually happening in terms of the growth in demand for fuel and the peaking of production of fuel, in terms of predictable changes in fuel costs and the budgets of people and organizations worldwide, in particular in certain places like the U.S., where there's so much dependency on foreign oil imports. And then the consequences of those budgetary issues on economic behaviors, buying, selling, lending, borrowing, and then on prices of real estate, stocks, and so on. So in addition to minimizing exposure to rapidly destabilizing markets like tech stocks in 2000, real estate starting in 2005, and financial stocks 2007, 2008, other stocks as well. In addition to minimizing exposures to those rapidly destabilizing markets, there are also enormous profits available for those who understand early what is changing and then adapt to benefit from what is changing. As all these, for instance, pieces of real estate are being sold, then somebody's going to own it. Somebody's going to own companies, somebody's going to own land, somebody's going to own buildings. Someone's going to have influence and responsibility for all of these accumulated resources, for oil, for gold, for water, for buildings, for land, and so on. All these accumulated resources are going to be utilized and controlled by certain people more than others, certain organizations more than others. So as things are shifting, there's tremendous opportunity as well as new risks. There's tremendous risk of real estate destabilizing even further than it has so far. What we've seen in just the last few years is minimal compared to what I anticipated and projected even as early as 2003. I'm very clear that what has manifested so far as of March of 2011 is not the culmination or end of the process. Fossil fuels are scarce on this planet, and until there's an issue with energy, until the issue with energy is resolved, economic activity of humanity will be changing in certain predictable ways and will continue to change, and amongst those changes are more and more focus on fuel and less on other things like gold or maybe even food, but there's some twist there because food transported from long distances, that's relying on fuel. So there's many implications. I'm not going to get into any further detail on it other than to say that local food production is increasingly likely as fuel prices continue to increase. But there's destabilizing markets, predictably destabilizing, and there's benefits available for control of natural resources, amongst other things, in particular oil and gasoline and so on. So further, as various legal systems and political systems adjust to changes in global economics and budgets, those who adapt early can minimize their exposure to legal and political risks and maximize their legal protections through the most reliable legal adaptations. And again, tax rates are likely to continue to increase. They've increased already some. Bankruptcy laws will continue to change. They've changed already some. And it's not hard to anticipate how, in general, those things will change. The legal system in terms of laws, tax laws, bankruptcy laws, and foreclosure laws, collection lawsuit laws. It's not that hard to anticipate the kinds of changes that are predictable, and also that there will be more controversies and more of certain kinds of legal cases. That political systems in some cases will destabilize. Libya and Egypt, but also the EU with Greece and Ireland. There will be changes in political patterns and political power structure. With the fall of the USSR and the decline of the US, those have been the two biggest producers of oil in the world so far. Well, the next potential superpower is Saudi Arabia, already rising tremendously in influence, has been since the 1970s, as well as other nations in the Middle East and other oil-producing nations like Venezuela. But there's that pocket in the Middle East, and Saudi Arabia is the one political jurisdiction that is in position to become the next global superpower, just as the US and USSR rose to power on oil production as the number one and number two producers of oil in the world in the 20th century. So in the 21st century, Saudi Arabia will produce more oil than anywhere else. Why? Because Saudi Arabia has more oil left than anywhere else, to the best of my knowledge. So there will be different adaptations that political systems will make, legal systems will make in terms of laws. Political stability will shift, political power will shift, tax rates will shift, buying and selling behavior will shift, budgets will shift, the cost of fuel will shift. All these things are predictable in that they will shift. Generally speaking, they're all predictable. The exact timing, the exact changes in terms of something like tax law, no, I can't predict how a locality's tax law is going to change in specific times. That's kind of ridiculous. But I can make general comments about tax laws in certain regions of the planet, right? So many things will change. Changing budgets, changing economic behaviors and thus changing prices, changing tax laws and bankruptcy laws and so on. Some people will adapt differently than others. Some sooner and some later. Some will notice earlier, some will notice later. Some will understand sooner, some will understand later. Some will adapt sooner, some will adapt later. And the different adaptations will produce different results depending on how well people understand what's available to them as well as their particular circumstances and what's relevant to them. But understanding makes a difference. So people who are surprised and aren't understanding these things in advance, they're making panicked, urgent interventions rather than planning. So I'm suggesting consider urgent interventions. That might be relevant, but also consider some planning. Adaptive budget consulting is for people who are open to planning, open to even benefiting from predictable changes. Adaptive budget consulting offers you support in understanding what is changing and exploring different alternatives available so you can choose the relevant methods for you to adapt to what is changing and even benefit from what is changing and benefit more than you would have without making those responsible adaptations. So you can minimize your financial risks and minimize your legal risks, political risks, and so on, plus maximize your legal protections and your financial benefits. You can position yourselves into the investments in the markets and the regions where there is growth, long-term growth and immediate growth, because people who are only interested in long-term growth may miss short-term opportunities that are quite valuable. So it's not just a matter of looking at long-term patterns. For instance, the Middle East is not necessarily the best place to invest in at any particular time. It's a matter of timing and a matter of, consideration. And what's relevant for an individual investor or an individual organization, a specific organization. So, in order to have the benefits of adaptiveness, all you have to do is call us. Or reply to this. You can reply to this video, you can reply to the blog posting if you have that available. It's that easy to get started now. Changes are happening, right? Some people will notice them first. Some people will even study changes and anticipate them. Some people will notice them second. Some people will notice them. Many people will notice them much later. Your clarity and understanding of change will then be reflected in your or my adaptations to change and how much we benefit from those changes. All changes have benefits available. Some greatly benefit, some slightly benefit, and some do not benefit and may have adverse consequences as a result of not anticipating change, not adapting, not understanding. So I invite you again, contact me, contact us, and adapt so that you may benefit from change.